Well, I think they're going to go through a rough period. You know, the market, the economy is slowing down a bit, and obviously all the trade wars. But I'm a big believer in China. I think the Chinese market is going to open up a lot faster than people believe. It's the second largest equity market in the world. It's trading at relatively cheap valuations. And, you know, this is a good entry point. Now, I'm not saying that things are not going to get worse. They could. But if you look at a long-term perspective, you ought to believe that China's
But in the short term, how much farther do you think it has to? What's the downside look like in the short term? What's the upside look like in the short term?
I think in the short term, you know, obviously it has to do a lot with geopolitics. You know, a little bit of the Fed, you know, tightening and emerging markets having compressing a little bit, but it's the geopolitics. Hopefully, in the next few months, we can see a trade deal between Trump and Xi Jinping, and if we see that, the market would run.
Ron says nobody's smart enough to be able to predict that, but yeah. You're a smart guy, so you want to predict what's going to happen?
Look, I think it's going to take time. You know, I think that we will probably see some announcement that they're working on it, but it's a big problem, and it's going to take some time to make it work.
But I think it's really interesting here. What Henry's business is he is the index provider. So whenever people are investing, they need to have his product, his services, so they can have proper diversification.
Right.
And he's the guy who invented it.
Right.
So he's the guy who invented it. He's the one who, because of him, it was started, was spun out, came public. He now has $300 million plus personally in this investment that he's created because, right?
Yep, it's been a good run.
So what exactly is the business?
MSCI?
Yeah.
MSCI, obviously, we're well known for as an index company, but what we are is we create tools for people to make better investment decisions of all type. A performance tool, risk tool, technology, data, anything, and that's how the company has grown so much.
So here's my question. You are an active manager. You like to pick companies and stocks like him or like his company. He's on the very opposite end of this, right?
So I can't, but there's been a tremendous move toward indexation. So he's the beneficiary of that. And the more people go to indexing, the better it is for me because there's fewer people that are going to be able. People can't generally beat the indexes. We beat the indexes. So for us, this is a good thing that there's less competition and we stand out more against everyone. We stand out more against the indexes.
You wrote in your letter in October that the volatility that we saw was in large part a function, though, of ETFs and of the CDS market. Is that a good thing or a bad thing? And is he at fault then?
Do you agree with that?
I don't think so. You know, look, the underlying fundamentals of any investment vehicle is going to be people buy and sell, right? You know, it used to be mutual fund. People will blame the volatility of the market because retail investors were leaving mutual funds. Now we blame them on ETF. You know, it's at the end of the day, these are investment vehicles. These are wrappers. And what matters is what is the belief of investor in the equity market. And if they don't have belief, they will leave and the market will go down.
What do you think of the idea? Seth Klarman has posited that passive investing has effectively perverted the market, effectively because it locks in certain companies at certain types of multiples and makes it actually much harder. Effectively, the more you believe in the efficient market theory, the less efficient the market really is.
Well, you still have 75–80% of the market being active, you know, in the world. So there is a huge amount of money actively managed that is basically investing on fundamentals. You know, the equity index is about getting an exposure to a market, and obviously passive investing is about that. So I think there is still a long way to go for passive investing before we begin to worry that it's taking over the world.
What about in the context of a crisis? When you think about especially the ETF market, right. What happens?
I think the ETF market will be as good as the underlying liquidity of the stocks in the ETFs. Because a lot of people talk about the ETF as if they were divorced from the markets themselves. So if you have a lot of liquidity in the stocks underlying the ETF will be fine. You know, the NAV will track very closely the underlying fundamentals of the stocks. One correction, though, 2/3 of our revenue come from active management clients, and only 1/3 come from passive. So I have a strong vested interest in Ron's success.